Hello and welcome to this session. This is Farhat, in which we will discuss factors affecting income and revenues. In the prior session, we looked at various ratios, and one of them was the profitability analysis. The profitability analysis measures how profit, whether it's revenues or net income, is performing vis-a-vis assets, like return on asset, vis-a-vis equity, earnings per share, price earnings ratio, and all other profitability ratios, gross profit, so on and so forth. Now, profitability ratios are very important. Why? Because profitability ratios deals with revenues and income. These numbers are extremely important for any company. Why? Because when we prepare an income statement, the top line, and in business we call it the top line, is revenues. Then we deduct our expenses. Then we get to income or net income, whether you want to call it income or net income. So notice we're looking at the top line and the bottom line. So in this session we would look at things, factors that will influence how we analyze revenues and net income. Now bear in mind, everything I mention in this recording, I know we have viewed it somewhere else, one way or another. For example, when we looked at limitations of ratios, we talked about what are the limitations of ratios, why are not as reliable as they should be, what are the limitations, what factors would influence the computation of ratios. When we looked at revenue recognition, we learned how to recognize revenue. When we looked at earnings quality, we learn what is good income, what is good quality earnings. So in this session, we're combining all this information into this session. The point I am trying to make, I don't believe I will be providing new information in this session, but I will be providing information specifically for factors that influence revenues, the top line on the income statement, and net income, the bottom line. So profitability analysis involves evaluating various elements such as income, variability of income. It's not only we want to look at income, we want to look at how variable is the income. We want to look at revenue trend. Also, to get to net income, you want to look at expense composition and cost of sales. Now in this session, we'll focus more on revenues and net income. And by product, how to get to net income? You subtract expenses. So everything that applies to revenues and income, in a sense, applies also to expenses. So in this process, what we're going to be discussing here helps us answer critical questions related to the quality and consistency of income. That matters to an analyst. How good is the earnings? How consistent are they? We can look at earnings trend. Are they trending up, trending down, flat, fluctuating, and the overall earnings potential for a business? Because if you are an investor or a creditor, you want to know the potential of the business, because if you want to invest, you're looking at the future. You want to look at revenues and income currently and in the past to project that future. That's all you can work with. You have to guess. The future is unknown, but the past would help you make a better projection. We would look at factors that affect revenues and expenses that you have to take into account as you are making these projections. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
First, income quality. Well, quality and persistence of income determine the reliability and future earnings potential of a business. If the income is persistent, what does that mean? If the income is constant over several years, this gives you some sort of safety, some sort of assurance that this income is a repeating income. If it's a repeating income for the past 5 years, if everything else stays the same, there's no reason for that income not to repeat in the next 3 to 5 years. So this is what the quality of the income is, if it's persistent. So high quality income stems from core operation, from what we do as a business, and different businesses do different things. They have one core business. For example, Google in the ad business, Farhat Lectures, I'm in the education business. This is our core operation. Your university is in the teaching business, and sustainability. So you want to have the income consistent from your main business. A clothing retailer consistently generating profit from apparel sales show high quality income because that's the business that they are in. Well, they might buy an investment in stocks, buy Nvidia stock, and Nvidia stock could go up and they might sell it and they could generate profit. But that's not what they do. This is not how we will judge this clothing retail store. The clothing retail store, its core operation is selling apparels. We will focus on that and make sure over the years they do sell those apparels consistently. Low quality income include one-time gain or non-operational revenue. One-time gains means what? For example, a company reporting significant profit due to a one-time contract that's not repeating, that's not going to replicate this income in future period. I always give this example, Caterpillar. In one particular year, 25% of Caterpillar revenue was from one Brazilian contract, a contract with the Brazilian government. That's it. One customer accounted for 25% of their profit. And guess what Caterpillar did? They did not disclose this information. Actually, they were penalized, and we'll talk about disclosure shortly. So if your income is not repeating, well, we need to know this, because good quality income is a repeating income. Let's talk about income and uses of estimates. One problem with income is the use of estimates, just like we talked about this when we talked about limitations of ratios. Income is a fundamental indicator of the firm financial performance, of course, and its measurement involves several subjective estimates. That's the problem. Estimates and accounting decisions, because with accounting decision comes estimate. Income calculation often required estimates such as revenue recognition, and we'll talk about revenue recognition shortly. We'll have a whole session about this in this recording. Estimating when and how much revenue should be recognized in complex transactions such as long-term contract. When we have a long-term contract, the way we account for revenue recognition gets a little bit more involved, subject to estimate. What's the degree of completion in this project? And based on that, it's an estimate will determine the total revenue. Asset depreciation. When we depreciate asset, we estimate the useful life of the asset. Also, we could be using straight line method versus the double declining or the 150 declining method. Well, using different depreciation method will give you a different expense. As a result, will give you a different income. Therefore, your income is subject to estimate. Based on the estimate, we're generating this income. Also, if we have any future liabilities, estimating obligation like warranty cost or pension liabilities, which require assumptions and estimate about future events. Well, that's going to affect the quality, the numbers that we're getting. Same concept would apply if you are predicting or estimating allowance for bad debt. That's an estimate, how much uncollectible you will have. For example, a manufacturing firm estimates a 5-year useful life for a new production machine and allocate its cost using the straight line method. This allocation directly affects the firm's income in each of the machine's year. First, you set 5. Why not 7? Why not 3? Use the straight line. Why not use another method? So depending on the method that you use, you're estimating this expense. Well, if you're estimating the expense, you're estimating net income. Accounting method. It's not only the estimate, the accounting method itself, you can choose one method over the other. The choice of methods and estimate can significantly impact financial statement and is a common source of fraud for that matter, because you could use different method to massage the numbers, to window dress the numbers. For example, completed contract method to recognize revenue only when the project is complete. This way you defer profit but reduce estimation risk. So one way to recognize long-term contract is to wait until the project is done and recognize revenue. For example, a construction company recognizes all revenue from a 5-year project in the final year. So if you have a 5-year project, 1, 2, 3, 4, 5, what you will do, you will wait and you don't recognize any revenue until year 5. And let's assume it's $1 million of profit or revenue. It doesn't matter. Or a company could use the percentage of completion method. If they use the percentage of completion method, they will, and let's assume they, for the sake of simplicity, this project would recognize revenue equally. They would recognize 200,000 every year. That's usually how it happens, but for the sake of simplicity, you want to make sure you are comfortable with the completed and the percentage of completion method. The reason I'm giving these simple examples to illustrate the point, to remind you that both revenues and net income are subject to accounting method. You change the accounting method, we can change the figures. It's not only accounting methods, also they are subject to estimates. So it's the kind of basically, it's like you could manipulate it from 2 different methods. Disclosure. How much you want to disclose about the company affect the quality of the revenues and the earnings that you are reporting. Financial statement disclosure and presentation provide manager with significant flexibility in how information is reported. And this discretion, guess what, can lead to differences that impact the financial statement analysis and comparability. If you're given the manager the flexibility to report, they might report numbers that they want you to see or emphasize certain income or revenue figures. So there's a variation in disclosure practices from company to company. Managers have the choice to group or separate financial items based on their judgment. For example, company A reports selling costs separately from general and administrative, providing detailed insight into operational expense. Company B combines selling administrative cost into a single line, limiting transparency for stockholders because they can have this option how to present things. Footnote disclosure, how much footnote disclosure you want to provide. The amount of detail provided in the financial statement can vary. For example, one company might provide extensive breakdown of debt terms, contingent liabilities, or revenue recognition policies. Another company might opt for minimal, just to meet the minimal requirement, leave analysts to infer details or request further classification. That's going to impact when your decision when you're analyzing revenue and income. Also keep in mind that financial statements users are of diverse nature. What does that mean? It means when we prepare financial statement, they are called a general purpose for a reason. A general purpose means anyone can use them. Who's anyone? Anyone is everyone. Investors, creditors, government, regulation, tax authority, suppliers, so on and so forth. So financial statements cater to a broad audience, but different users group prioritize different aspect of them. So when a creditor is looking at the financial statement, what they see is totally different from an investor, because their motivation why they're looking at these financial statements, they're looking for different things. Investors focus on profitability trend to gauge potential return. That's what they're interested in. So if you're an investor, you're looking at their profitability, because profit generate more income, increase earnings per share, increase the stock price. So an investor analyzing a tech company's net income growth over the past 5 years to decide buying the shares. They're looking at income. That's what they're focusing on. Creditors, they don't care about income. They want to look at your liquidity. Do you have enough money, and are you going to survive solvency to pay them back the loan and the interest? That's all what they care about. If you break even if you make a small loss, they really don't care. All what they care is, do you have enough cash in your bank account, and are you going to survive as a company? Solvency and liquidity. So a bank assessing a construction firm operating income and cash flow to approve a business loan. All what they care about, can you survive? Can you make it enough cash so you pay us? We don't care about your stock price. That's not our concern. Again, both groups, the point is both groups are using the same financial statement, but each one is analyzing the company from a different perspective. Regulators are looking for your compliance. The SEC scrutinize a pharmaceutical company's revenue recognition practices to protect investors' interests. That's their job. Their job is to protect investors' interests. They're not looking to invest. They're not looking to lend you money. They're looking at the same numbers, the same revenue policies that investors and creditors are looking at, but they're making a different conclusion. They're coming up with a different conclusion about what you are doing. And you have competitors. Well, those they have always a malicious reason to analyze your company, malicious relative to your company, analyzing profitability for benchmarking. They're looking how well you are doing. Okay, a rival restaurant chain reviewing a competitor gross profit margin to refine their pricing strategy. Now, this group of people, your competitors, would look at the financial statement, look at your revenues minus your cost of goods sold to get your gross profit, but for totally different reasons, although they're looking at the same numbers. The point is how we analyze revenues, expenses, and income differ because we're different users. One, two, the factors that goes into this, the accounting method being used, the estimates that are embedded. So we have to take all that into account. Let's go back to revenues. Revenues, remember, is the lifeblood of the company. Without revenues, you cannot survive, because without revenues, you will not have net income. So revenues represent the inflows of assets or reduction of liabilities. It means reduction of liabilities. It's when you have an obligation and you meet this obligation and you can recognize your revenue, like unearned revenue, resulting from activities that form from the core operation of the business. Remember, revenues comes from what you do, core operations. Farhat Lectures, education. That's their core operation. Google, ads. Facebook, ads. Microsoft, they sell software. Apple computers, they sell iPhone, among other things, but that's part of their core operation. Revenues are generated through the delivery of goods, provisions of services, or completion of activities integral to the firm's central operation. This is what revenue is. It's whatever you do to meet your customer needs. And that main thing is your core operation. A company could have more than one source of revenue, but usually they will have one or two that are major and the others are minor. So revenues increase the company's asset or decrease its liabilities. Decrease in its liabilities is when you perform your obligation under unearned revenue. When you have an obligation to perform and you perform, your liabilities goes down and your revenue goes up. A retail store recognizes revenue from the sale of clothing. That's their revenue. A consulting firm recognizes revenue from advisory services provided to its client. So understanding the nature, recognition, and criteria and timing of revenue is essential for accurate financial reporting and analysis. So as a user, you need to be familiar with the nature. What type of revenue are we dealing with? Recognition criteria, which we'll look at next. And the timing of revenue. Sometimes revenue can be recognized immediately at the point of sale. Sometimes revenue might be recognized later. It means you have to wait until you recognize the revenue later. Later means after you perform the service down the road. The revenue is deferred. So revenue recognition criteria, we say revenue are recognized. It means recorded when they are realized or realizable and earned. So those are the conditions. Realized, realizable, and earned. Those are the criteria. So what is realized, realizable? Okay, these principles help ensure that reported revenue reflect economic activity. Starting with realized revenue. Revenue are considered realized when there has been an exchange of goods and services for cash or claims to cash. What does that mean? It means if you satisfied your obligation, if you performed your work, your revenue is realized. So a bakery sells cakes to a customer who pays immediately in cash. The revenue is realized at the point of sale. Now also, if that customer did not pay, promised to pay, we still have revenues. A furniture store delivers a sofa to a customer and issues an invoice. That's good enough. The revenue is realized even though payment will be received later, as the receivable represent a claim to cash. That's also revenue. Realizable revenue, when goods or services are exchanged for asset that can be easily converted into cash or claim to cash. They don't have to pay you in cash as long as it's something that you can use. For example, electronic manufacturers trade its product for negotiable securities that can be easily sold to cash. This transaction makes the revenue realizable. That's good enough. What's earned revenue? Revenues are earned when the company has substantially completed the earning process and is entitled to the benefit. Like what? A construction company completes a project for a client. Once the project is finished and approved by the client, the revenue is considered earned even if the payment is deferred. So earned is you have earned it, you have did the work, completed, earned revenue. Now keep in mind, this is what I just did is a simplified revenue recognition. Why? Because you have one whole session and you need to be familiar with the 5 steps in revenue recognition lesson. But the point I'm trying to make is you need to be familiar with the nature and recognition criteria of revenue. Timing of revenue, as we said, most of the time, I didn't mention this, but most of the time, typically, you would recognize revenue at the point of sales when goods are delivered or services are rendered, as these events signify the completion of the earning process. So when you go to the supermarket or when you go to a store and you buy, as soon as the clerk scans the item, gives you the item, you hand in the money or the credit card, that's it. That is when sales is recognized. A car dealership recognizes revenue when a vehicle is handed over to the customer, signaling the completion of a sale. This is called revenue recognition at the time of the sale. Same thing with services. A lawyer completes legal services for a client. The revenue is recognized once the service is performed, regardless of when the client pays the bill. Now we have something called deferred or unearned revenue. This occurs, and you should be familiar with this, when the customer pays upfront. So the customer pays the money before you deliver anything. Okay, revenue recognition may be delayed if the payment is received before the earning process is completed. Again, I'm not going to go into the accounting part of it. You need to be familiar with this. A magazine publisher receives a 1-year subscription fee upfront. The revenue is recognized monthly as issues are delivered to the subscribers. That's so this way you in this example, you have the money in the bank, but that money is not revenue. It's not revenue until you deliver. You have earned the service, and earning the service means delivering your bargain of the deal, delivering that monthly magazine subscription. And sometimes revenue is not earned until after the work is done. And this is under long-term contract. For projects spanning multiple accounting period, revenue might be recognized incrementally sometime, or sometime you have to wait until the project is end. But you could also recognize it incrementally before the project has ended. Remember at the beginning I said if it's a 5-year project, you could recognize some of the revenue, and you need to know the criteria when you can do it and how you will need to do it. That's also a separate lesson based on the percentage of completion. So a construction firm building a multi-year project recognizes revenue as work progresses according to contract milestone. But again, who determine those milestone contract estimates? Let's take a look at this multiple choice question from farhatlectures.com. How does the classification of earning from temporary investments as operating or non-operating affect financial reporting? So the classification means what? It means where things are put on the income statement. How does the classification of earnings, whether it's temporary investment, as operating or non-operating, affect the financial reporting? Well, it has no impact on the financial statement users. Well, yeah, it should have an impact, because if it's temporary investments and it's operating, it's going to increase operating income. But if this temporary investment should be considered non-operating, it should be under non-operating. So it has an impact. It does not have an impact. At the end of the day, the net income is the same, whether it's an operating or non-operating, but we need to know your core operation. Remember, when you're evaluating a company, what you care about is their core operation, because they have also a non-operating income section. B, it directly influences the presentation of the core business profitability. Yes, it does. If you are including temporary investment as operating income, you are inflating this core business profitability. Remember what I told you, what you care about is the core business. It directly influences, of course it does. So let's keep B. It alters the total revenue figures reported on the income statement. No, it does not. It does not, whether it's reported with operating or non-operating. The total is the same. It affects only the footnote disclosure. No, it does not. It also affects the presentation on the actual income statement, not only the footnote disclosure. So the answer is it directly influences the presentation of the core business profitability, because what you care about is the core business profitability. When you include temporary investment as part of it, and it should be part of non-operating, well, you are influencing the presentation of the core business, which in turn influencing the decision making, which in turn influencing how you see income for that company. What should you do now? You want to go to Farhat Lectures, look at additional resources, MCQs, lectures that's going to help you do what? Perform better, whether you are studying for your CMA exam, CPA exam, accounting, or finance courses. Invest in yourself.